Hey Bowtie Nation, Joseph Hogue here, finally updating our 2020 dividend stock portfolio. There was just so much going on, I missed our June update, but I wanted to take this opportunity to do a stocks to buy in July video and share a very important investing idea with you. Nation, after a 40% rebound off the March lows, it has become very difficult finding good stock picks for the portfolio. Almost nothing looks cheap, and the stocks that are still off their highs are that way for a reason. So I wanted to use this video to show you how I look at a portfolio to see which stocks to buy, and where the gaps and risks might be in a portfolio, and what stocks to watch to decrease that risk. We'll first do a quick recap of the 2020 dividend portfolio, see where we're at with our dividend stocks. Then I'm going to show you how to find the gaps and the risks in your own portfolio by using our 2020 portfolio as an example, and reveal those 3 stocks that I'm buying in July to fill in the gaps. I'll be putting these stocks in our portfolio on M1 Finance, and I love the platform for that automatic reinvesting function. I can just put in what percentage of my money I want in each stock or the fund, and the website is going to automatically invest any new money across that group. Now, M1 is totally free to use and offers some great savings rates and features. I'll leave a link in the video description below, so make sure you check that out. So let's look at the portfolio, but I want to send one last shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. So here's our dividend portfolio as of last week, and while it says a 20% return here, that's actually over the last year. So we're actually sitting on about a 1% loss year to date, which is still better than the 6% loss on the stock market so far in 2020. Here's the portfolio itself, and we have 6 funds and 13 individual stocks. Some of the standouts here include the Vanguard Real Estate Trust, ticker VNQ, and I love this fund as an easy way to get that broad exposure in real estate. We invested in shares of AIG in May and are already up 31% on the investment. Now, this was one of the top picks by analysts at the time and a solid 4.3% dividend yield. The investments here in the Global Medical REIT, ticker GMRE, and the Vanguard Short-Term Bond Fund, ticker BSV, have really helped support the portfolio when the rest of the market crashed. Unfortunately, we've got some real dogs here as well. We put on that investment in Carnival, ticker CCL, in January at exactly the wrong time. Now, I still like Carnival as a very long-term investment, but it's going to take time to see any kind of certainty on that. Westrock, ticker WRK, and Telefonica, ticker TEF, were also part of those January additions to the portfolio and still dragging down the rest of the returns. So this month, what I want to do is share my thought process for looking at a portfolio and deciding what to add. And once you've already got a portfolio of a few funds and a handful of individual stocks, rather than just blindly making new stock picks, it becomes much more important that you look at your portfolio as a whole and then find those gaps and the risks in it. It is only in looking at it this way that you're going to be able to avoid the worst of a market crash if all your stocks are concentrated in just a few sectors of the economy. I'm going to be using our portfolio spreadsheet tracker to find those gaps. I'll leave a link to download the spreadsheet in the video description below, but even if you don't have it, you can still do what we're going to be looking at with your portfolio. The first thing we'll do is put all our current stocks and funds in the spreadsheet and then load the stock data from the internet. This is going to bring in the asset class, the sector, and the industry for each stock. That way we can get an idea of how much we have in each already in the portfolio. Once that's done, we can click the Overview tab, and it shows us how much of the portfolio is in stocks, bonds, and real estate, as well as some of these other assets if you have them. Now, if you don't have the spreadsheet, basically you're just finding the dollar amount you have invested in these 3 asset classes and the percentage of your total portfolio. So you add up the value of all your bonds and your bond funds, your stock and stock funds, and your real estate holdings. And why this is important is because those broad asset classes, stocks, bonds, and real estate, they react differently to the economy and can do different things for your wealth. Stocks are higher growth, but can be like a roller coaster sometimes. Bonds are going to be slower growth, but provide that ultimate safety net like the bond fund did for our portfolio in March. Now, bonds and real estate can also provide some of that nice cash flow above what you usually get with dividend stocks. And here our asset breakdown says we have 76% in stocks, 14% in bonds, and 10% of the portfolio in real estate funds. That's probably a little low in real estate and bonds if I'm thinking that stocks are looking expensive here, so I might want to add a position in one of those 2 asset classes. Maybe buy another real estate or a bond fund to give me a little bit more protection against another market crash. Nation, do not neglect this asset level view of your portfolio. I know since the March lows, everyone has been a stock picking genius, making double-digit returns on stocks like NEO and Nikola, but that's not going to last forever. You need that holistic portfolio with some bonds and real estate to get you away from those risks in stocks. One last step here, and now we want to look at the portfolio on what sectors we're investing in and maybe what we're neglecting. With the big move in tech this year, I know a lot of investors are almost exclusively invested in the sector. And that's great when the market gods are shining down. But again, what goes up can just as easily come crashing down just as fast. So part of the spreadsheet is that it finds the sector for each of your stocks, adds up the percentage you have in that sector, and then shows it here on the right along with these colored bars. It also looks at what percentage that sector makes up the S&P 500 market index to give you an idea of whether you're over or underweight the sector compared to the market. And for our dividend portfolio, we can see it's underweight in that communication services, financials, healthcare, and industrials and tech stocks. We've got just 4% of the portfolio in healthcare through Gilead Sciences versus a 15% weight in the overall market. But that's still quite a bit less than how much stocks of financial companies make up the S&P 500. And I do like both healthcare and financials here. If you look at the PE ratios for each sector, here I've got the chart from FactSet Earnings Insight, and you can compare each sector against its 10-year average price to earnings ratio. Healthcare and financials are two of the most inexpensive groups right now. Compared to sectors like tech stocks trading at 58% above their long-term PE ratios, healthcare looks like a steal at a premium of just 12%, and even the 24% premium on financials isn't too bad. And besides helping you find those gaps and the risks in your portfolio, this kind of process just makes it so much easier to pick stocks to buy, instead of trying to find stocks to watch from the entire market. So the thousands of stocks traded on the exchanges, you can instantly narrow your search down just to a few hundred within a sector. So using this, I found 3 stocks to buy in July. 3 I'll be adding to our 2020 dividend stock portfolio. First is $82 billion pharmacy giant CVS Health, ticker CVS, for that increased exposure to healthcare and its 3.1% dividend yield. Now, most healthcare stocks paying a 3% or higher yield are going to be those drug makers, and since we've already got a Gilead Sciences here, and I'm talking about AbbVie in another video this week, I wanted to add CVS here. The company has an unrivaled advantage in healthcare delivery, retail, and insurance with almost 10,000 retail stores. And they've ramped up testing to capacity to 1.5 million through thousands of COVID drive-through sites and could be looking at a huge opportunity in that vaccine delivery when it's developed. CVS booked an 8.3% sales growth last quarter and 18% earnings growth, which is actually pretty amazing considering the rest of the market reported an earnings decline of about 5%. Management said about 5.5% of that was from benefit on COVID testing and the activity, so this is going to be a great play whether we see a rise in those cases or not. Earnings are expected slightly lower to $7.07 a share over the next year, but management has a history of beating expectations, and this one is trading at just 8.6 times earnings. Analyst price targets range from $66 on the low side to $94 per share over the next year, which would be almost a 50% return on top of that dividend. For our financial stock, I'm buying Regions Financials, ticker RF, and a 5.3% dividend yield. Now, the Federal Reserve released its recent stress test last week and came down hard on the banks. Okay, what happened is the central bank said that in the event that we get a really bad recession from all this, banks don't have as much cash on hand as it would like to see, so it limited the cash payouts they could make through share buybacks and dividends. Of course, that hit the bank stocks hard because investors were worried about who would cut their dividends, especially for some of these high-yield payers like Wells Fargo and Regions. Now, Regions is primarily a Southwest regional bank where a lot of the states didn't close down to the extent that we saw across the country. They are now seeing an increase in COVID cases lately, but the bank still reports that 97% of its branches remain open for that drive-through or appointments. Now, if you look at the bank earnings over the last quarter, they were absolutely horrible, like all banks were. Regions missed expectations by 9 cents to report just 14 cents per share, less than half the earnings it reported in the last year's first quarter. What happened, though, is they shifted $373 million of earnings to that loan loss provision, kind of a separate savings account that it sets aside just in case a recession causes more loan defaults. Now, this $373 million shift was an increase of 310% from the prior year's quarter, so a huge move to shore up the bank's finances, and without this, earnings per share would have been more than triple to over 40 cents a share. Now, if we look into the company's earnings report, we did see an increase in net charge-offs reported in that first quarter, and that's the bank loans that don't get paid back. These charge-offs amounted to $123 million in the quarter from $96 million in Q4 of last year. And while business loans did tick up, it's still less than 0.6% of all loans charged off. In fact, I think the banks are shifting more than they need to those loan loss provisions. So if the economy does rebound faster or the recession isn't as bad as some people think, we could see much higher than expected earnings over the next year. Earnings of $1.29 over the last year means shares are trading at 8.3 times on a PE basis and just 70% of book value. Earnings are expected lower over the next 4 quarters, but this is still a solid dividend stock trading deep in value territory. Analyst targets range from $9 per share on the low end to $16 each over the next year, so a pretty big spread, but I like it for a rebound to at least $12 a share on top of that dividend. I'm also adding to our position in Global Medical REIT, ticker GMRE, and its 7.3% dividend yield. So this is going to not only increase our healthcare exposure, but also the amount we have in real estate in the portfolio. GMRE owns almost $1 billion in medical properties, with 115 billions across more than half the nation. Not only should healthcare properties do relatively well compared to other real estate, the average lease term here of over 8 years means vacancy and rents should remain fairly stable. And I like Global Medical here because unlike a lot of the other healthcare REITs that we look at, its portfolio is in medical office and hospital instead of those senior care and the long-term care facilities. Leases target a built-in rent escalator of 2% annually and are on triple net lease terms, which means the tenant pays all the costs and just keeps sending those checks to the company. Of course, the problem right now for those medical office and the hospitals is that elective surgeries have been pushed back to make room for the COVID patients. Now, those elective surgeries are higher profit, so hospital earnings are lower, but again, on those triple net lease terms, it doesn't hurt Global Medical quite as much. Only one analyst here with a price target of $12 per share, so don't read too much into this, but I like the shares on a rebound to $13 each on top of that 7% dividend yield. Click on the video to the right for my 5 favorite stocks for total returns, not just dividends. 5 stocks with an average expected return of 80% and higher. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.